Good morning, YouTubers. Welcome to my channel, Leanne Mazaret at YouTube. Today, I'm walking and talking to you about financing your investment properties. Now, some of you may have enough cash to just go out and buy a property in cash. And then there's the rest of us in the world who either don't have that much money or want to take all the money that it would cost to buy one property and spread it across 4 or 5 properties because we only have to put 20% down. Now, back in the day, before the mortgage crash, you might have heard about zero down loans and no docs kind of financing. No docs meaning no credit checks. You just state your income. It's called stated income. And then, they just give you a loan based on your own ability to pay, and it's secured by the property. Yeah, well, those days are gone. And conventional credit is pretty hard to get, even if you do have a good credit rating. So a lot of banks aren't even talking to people if they don't have a 720 credit rating or above. So that leaves the rest of us who maybe have a ding from a while back on their credit that's going to stay on there for 7 years or 10 years or something like that. That leaves the rest of us in a position of no funds. So where do we go? Where do the rest of us go? We go to private lenders. What's a private lender? It's an individual or group of individuals who lend money to investors that are buying properties to secure the loan. So in other words, they hold the first trust deed or the first mortgage on the property. You pay them. If you don't pay, they foreclose. Take your property, and that's that. Not so different than a regular mortgage. The difference is, however, that they're not as concerned with your credit rating, because in exchange for that increased risk that they're taking on you as a subprime subprime borrower, they're going to ask for a much higher interest rate and a much shorter term. So for example, if you're looking at a 30-year mortgage in the conventional marketplace, you might be looking at 4%, 3.5%. If you have super great credit, maybe even under 3. I don't know, depending on what you're looking to do or get or what kind of property it is. But it's going to take you a long time to get that money, because you have to have an appraisal, and then you'll have to go through all the bank's underwriting process, including the appraisal, including the credit check, including any types of repairs or anything that they want to see done before they'll fund the loan for you. So that typically doesn't work well for fixer-uppers and bank-owned properties that require you to pay cash at the end of the auction or within 2 weeks of the contract date after a small, short inspection period. It usually just isn't going to work with a conventional bank anyway, even if your credit is good enough for them. So again, a lot of us go to these private lenders, and some of them can be very huge lenders who are borrowing institutional money at one interest rate and lending it at another. So they're actually in the business of arbitraging, because it's not really their money. So let's say they owe it at 3% or 4% and they're lending it to you at 12%. Well, they're making 8 or 9% in the middle that they're keeping. So that's just pure profit for them. And they don't really have to do anything once they set up the loan. And for that, they also charge you a fee. You're probably going to pay anywhere between, probably a minimum of $1,500 up to 2.5, 3.5 points for your loan with a private lender, in addition to the interest that you'll pay. And you're probably going to have to pay some cash up front, usually 20-25%. And until they get to know you and do some business with you, you might have to pay a lot, the higher end of those ranges. So how does it work? How do you find them? Well, you can find private money lenders just by Googling them on your state or in your state. Or you can go to your local real estate investment club. Those things are replete with private money lenders looking to do business loans with people just like you. And once you find them, you can also contact me. I can help you find them if you're one of my mentoring students. But apart from that, once you find them, then they're going to ask you for your loan docs, and then they'll talk to you about their process for funding the loan. Good morning.
Morning.
Hi, beautiful. Hi. Yeah, hi. So, just gorgeous dog walking by. Anyways, they'll ask you for information about your loan docs that usually is fairly streamlined. I mean, they're probably going to want to see your bank statements. They may or may not ask for your tax returns. But if you're self-employed, if you don't have 2 years worth of self-employment tax returns, those probably aren't going to help you. But if you are doing this part-time and you're still working full-time, well, you know, maybe your tax returns will help you. Maybe they won't. But they're looking for a couple of things. They want to make sure that you have enough reserves in the bank to fix up the property and make it saleable so that they have a viable asset and can recover the money they're lending you at later on in time. Because they're just like a regular bank. They're not in the business of disposing of properties that they've had to foreclose on. They really don't want to do that. So they want to check to see what your plans are for rehabbing, whether you know what you're doing, have any experience, recent experience, and if you have enough cash reserves. So some places will just say, okay, that's good, and they'll fund your escrow on your day of closing. Others will need to have a small inspection, like maybe a drive-by inspection, or maybe they'll want to set up the equivalent of an escrow account and disperse your rehab funds to you, just to make sure you have enough skin in the game. So those are two different types of loans you can get. They either lend you 65-70% of the after repair value, or they just lend you 80% of the purchase price. So those are typically types of private investor loans that you can get when you're in the investment market. So now, what happens then? Okay, so you get your money, the seller gets paid, and now it's time to start rehabbing. Well, you know, that's a different subject. I've made a bunch of videos on how to get started, how to prioritize your work, how to manage your subs, and different project considerations. But for today, I just want to talk to you about financing. And also just bear in mind that any financing that you get usually will not appear on your credit rating unless you default. But they will probably look at your credit rating, so do have some kind of a credit monitoring service if your credit is not where you want it to be, so that changes in your credit or mistakes in your credit are things that you can take care of before they bite you in the bum when you are not expecting it. If there's judgments on there that have been satisfied, get them removed, or have a letter and ask the clerk of that court to stop reporting it as unsatisfied, or challenge the credit agency and ask them to double check, or give them proof. If you have a letter from the court, send it to the credit agencies and say, hey, look, this is paid, take it off there. Or if you have undue credit inquiries, you know, bear in mind, if every time you apply for credit on a hard inquiry, it goes on your report, and it may stay on there for up to 2 years. These credit monitoring agencies will tell you when that one is due to come off. So creditkarma.com, I think that's a free one. That's really good. There's other ones. That's the one I use, creditkarma.com. And I'll try to put a link to it here. So those are things that can hurt you. Also, if you have a lot of credit cards, or even if you have one credit card, they don't like to see you utilizing more than 30% of it month after month after month. So if you run up your bill, be prepared to pay it off right away the next month or when the bill comes due. They like to see that because that shows your liquidity, responsibility, you're not going to be carrying a balance, and that you're not going to have a lot of undue and expensive short-term consumer credit bills that might compete with your ability to pay your mortgage. It just shows that you're not credit hungry as well. If you have to open a bunch of accounts and they're only $200 and $300 accounts, I mean, what's the point of that? You're not really getting much money. And if you run up, you know, if you have a $300 credit limit, you spend $150, you're already showing a 50% utilization rate on your credit, outstanding credit. It doesn't matter that it's only $150. They just see 50% utilization rate and they ding your credit. They take you down a notch. So try to stay below 30% of your open credit lines. If you have credit lines that are not yours, that are showing up in your credit report, get rid of them. I've had year after year my mother's mortgage accounts and my mother's checking accounts show up on my credit. Now, luckily they weren't derogatory, but by the same token, they're not mine. They shouldn't be on there. And also check your spelling of your name, because I think they have probably 6 or 7 different permutations of the spelling of my name, all under which credit has been reported. So that's just confusing and messy, and you might be able to straighten that out, I mean. So credit matters. It matters more in conventional loans, but conventional financing is a lot less expensive. If you don't want to wait, jump through their hoops, you want quick access to money, find sources for private loans, private mortgages, private lending. They're all over the place, especially now since the regular credit markets are so tight. Be prepared to pay more, and then you can get busy and leverage, and you can have 5 houses for the price of 1 fully paid in cash house. If you don't like credit at all, you know, just want to do 1 house at a time, maybe fix it and flip it, get all your money back and avoid the interest expense and the loan costs, go for it. That works too. It's just a little slower pace and you just don't have any leverage. So that's my news for today. Financing your investment property purchases and managing your credit. Hope you've enjoyed this lovely walk with me this morning on my YouTube channel. Signing off, Leanne Mazzari on YouTube. Ciao for now.